All right, let's talk about Kaiser Aluminum. Their latest earnings report, it's a real head-scratcher. I mean, on the surface, they absolutely knocked it out of the park. A huge beat. But then, you look at the stock, and it dropped almost 5% on the day. So, what's going on here? We're going to dig into the numbers, unpack the story they're telling, and figure out what this all means for the stock going forward. Okay, so let's break this down. It really is a tale of two tapes, isn't it? In one corner, you've got this absolute monster of a quarter. We're talking adjusted earnings of $1.21, when the street was only looking for 74 cents. I mean, that's not just a beat, that's a knockout. Revenue, same story, a big beat. But then, in the other corner, you have the market's reaction. A pretty brutal sell-off. The big question is, what on earth did investors see that made them hit the sell button so hard? That's the mystery we're going to unravel. All right, so before we get to the big plot twist, let's stick with the good news for a minute. Let's look at why this report really should have sent the stock flying. Because honestly, the headline numbers were just fantastic. They really paint a picture of a company that's firing on all cylinders.
And look at the scale of this thing. This wasn't just some tiny squeak-by beat. It was a complete blowout. Adjusted EPS came in more than 60% higher than Wall Street was expecting. 60%. And revenue, over $36 million ahead of what anyone predicted. Management said it was all thanks to strong pricing and a better product mix, and you can see it right there in that adjusted EBITDA margin, a super healthy 18.1%.
And, management was feeling pretty good about it too. The CEO, Keith Harvey, came out and said the results exceeded expectations. And to prove it wasn't just talk, they actually raised their full-year profit forecast. They're now guiding for adjusted EBITDA to grow 10 to 15% for the whole year. Now, you know the drill. A beat on earnings and a raise on guidance, that's textbook stuff for a stock rally, but not this time.
And this is where the story takes a sharp turn. All that good news, all that positive momentum, it just came to a screeching halt. Why? Because savvy investors looked right past the flashy profit numbers and zeroed in on one single critical line item. And that's what changed everything.
This is it. This is the number that just torpedoed the whole story. A massive, massive cut to their free cash flow guidance. They went from telling the market to expect over $100 million for the year, all the way down to a range of just 50 to 70 million. I mean, that's basically cutting it in half. For any investor who cares about actual cash, which is, all of them, this was a giant red flag that just overshadowed all the good news. So naturally, this leads to the big question, right? The one every analyst was probably screaming into their phone, if you're making all this profit, where's the cash? Where did it go? Well, the answer gets into a little bit of accounting, but it's super important to understand what happened here.
And it all comes down to something called working capital. The easiest way to think about it is this. It's the cash a company needs just to keep the lights on and the doors open day to day. You figure it out by looking at current assets, stuff like the raw aluminum they have sitting in a warehouse, and you subtract current liabilities. The key thing to get here is that if the value of that inventory suddenly skyrockets, it can basically act like a sponge and just soak up a ton of cash.
Okay, so let's walk through how this exact scenario played out for Kaiser. Step 1. The price of raw aluminum goes through the roof thanks in part to tariffs and other market stuff. Now, Kaiser was actually being pretty smart about this. They reduced the physical amount of inventory they were holding, fewer pounds of metal. But here's the catch. Because each one of those pounds was suddenly worth way more money, the total dollar value of their inventory didn't really budge. All that value just sat there, tying up cash, and that's what squeezed their working capital and forced them to make that painful guidance cut. So, with investors spooked, this is where management steps in and tries to change the conversation. Their message was basically, okay, we get it. The cash flow number for this year isn't great, but that's a temporary problem. You need to look past that and focus on the big picture, on our long-term plan. And the core of their pitch is this. Think of 2025 as a transition year. It's a year of investment. They're telling everyone that the real reward, what they're actually calling the payoff year, is 2026. That's when all these big projects they've been pouring money into will finally be up and running, and they'll start spitting out some serious returns. And really, their whole game plan boils down to two huge projects. First, later this year, their big expansion at Trentwood is set to come online. That's going to seriously boost their capacity for the really profitable aerospace and engineering stuff. And then, at about the same time, their new coating line at the Warwick plant will hit full steam, which helps them dominate in packaging. And let's be clear, these aren't minor upgrades. These are potential game changers for the company's bottom line. And you know what? The overall demand picture actually seems to support this big bet they're making. Take aerospace, their biggest market. Right now, there's a bit of an inventory glut, but that's expected to clear out right around the end of this year. Perfect timing, right? Just as Kaiser's new capacity is ready to go. And then you look at packaging, where demand is already higher than supply.
Everything else looks solid too. So the timing looks really smart, assuming they can pull it all off.
So, that brings us to the big question. How do you balance this short-term cash flow pain with the promise of a big long-term payoff? Well, let's put on our analyst hats and make our official next call.
You know, it really boils down to two completely different stories fighting for control of the narrative. You've got the bulls, and they're laser-focused on 2026. They see the raised profit guidance, these massive projects about to cross the finish line, and they're dreaming about those juicy mid to high 20% EBITDA margins. But then you have the bears, and frankly, they're looking at the here and now. They see that ugly free cash flow number, the pressure from working capital, and they're worried about the risk. What if these big projects don't ramp up as smoothly as planned?
So, what's our call? For the next quarter, we're expecting things to be, well, kind of flat to maybe slightly up. The strength they're seeing in packaging should start to balance out the last bit of weakness from that aerospace inventory issue. As for the stock price, we think it's going to be stuck in a range, probably bouncing between $85 and $95. The market is in full-on show-me mode right now. It's waiting for concrete proof that these projects are actually delivering the goods before it's willing to send the stock higher.
And because of that, we're slapping a market perform rating on the stock. Look, the long-term story they're selling is compelling. It really is. But you just can't ignore the very real risks in the short term, especially around execution and getting that cash flow back on track. The potential is huge, but so are the hurdles they have to clear first.
And so that leaves us with the one question that's going to define this stock for the next year and a half. Is management playing chess, making a brilliant strategic bet on the future, or are they playing checkers, underestimating the very real risks right in front of them? The answer to that question is what will decide if today's stock price is a huge buying opportunity or a serious warning sign.
And of course, just a reminder, this is for informational purposes only. You've always got to do your own research. This is not financial advice.